Welcome, dear traders. It's me, Kate Stichin, and you are watching a recap of the Asian session. Asian stock indexes kicked off the week with a moderate decline. Despite upbeat US inflation data, risk appetite did not improve in the equity markets. Let's discuss what factors impacted market sentiment and what movements prevailed on the forex. Last week, the main driver undoubtedly was the US inflation data. A rise in the consumer price index in June was the lowest in the last 2 years. Wholesale prices also eased significantly. The market reaction to these reports was quite predictable. Stocks jumped and the US dollar index dived below 100 points. Now, dovish expectations are rather high even despite the fact that policymakers are cautious. They have not declared victory over inflation yet. In the next week and a half, Fed officials will not provide any comments. Until July 26, the blackout period will last. There is a hope that the regulator could change its stance. Previously, such hopes were groundless, but now they are more than real. The watchdog could also engineer the so-called soft landing. It means that the Fed will be able to lower price pressure and avoid a recession. According to the CME FedWatch Tool, almost 96% of investors anticipate another quarter-point rate hike next week. The US dollar plunged to its 15-month low due to the expectations of the end of the tightening cycle. By the end of last week, the greenback depreciated by 2.2% across the board. For the first time since March, leading hedge funds opened only short positions on the US dollar. The US currency started Monday in the bearish channel, over 99.80 and 100 points. As the markets await new economic and political news, the US dollar slightly recovered after logging its worst weekly performance last week. At the same time, it was rather volatile. At the end of the session, it was trading at 99.80. Any significant rise seems unlikely now, especially when the monetary policy prospects of the Fed and the ECB differ. If the Fed is expected to stop raising rates after the July meeting, the ECB may undertake another rate increase. This will boost the euro, whereas the US dollar will drop markedly. A fall in the greenback last week triggered an increase in the long positions for the yen, and the upside potential of the Japanese currency was only limited by the rise in yields of US government bonds. Treasuries grew after the speech of a Fed official, Christopher Waller, and the politician said that he would support 2 more 25 basis point rate hikes this year. Nevertheless, on Monday, the yen still maintained its upward movement. The pair hit a swing low below 138.40 and then recovered to 138.60. In general, in the 2 weeks since June 30, the Japanese currency has added more than 780 pips. The support level is located now at 138.30. The resistance level is seen at 138.90. At the same time, only 15% of analysts predict further growth of the yen against the backdrop of aggressive tightening by the central banks worldwide. And the Japanese regulator sticks to an ultra-loose stance. There were no clear signal from either the government of the central bank about the policy reversal. Moreover, Japanese Finance Minister Shunichi Suzuki said at the G20 summit that there was no discussion about intervention in the foreign exchange market. It might trigger a decrease in the yen. No crucial economic reports are on tap this week, and today trading floors in Japan are closed on the occasion of a Marine Day. Therefore, the trajectory of the dollar-yen pair will mainly depend on news from the United States and the European Union and China. Asian stocks also fell following downbeat China's macro stats and geopolitical tensions. GDP in the second quarter was 1% below market forecast and grew by only 6.3%. Besides, the latest data was distorted due to the low base effect last year when Shanghai and other major cities maintained tough restrictions. Concerns over the US-China conflict also undermined optimism in the region. Nevertheless, these events did not affect forex. Investors have already digested the weak data for the first 2 quarters, and they are curious whether the Chinese government will adopt new stimulus measures to boost the economy. In the meantime, the Chinese authorities make money injections into the market, increasing the yuan liquidity. Pessimistic data from China and the low exchange rate of the yuan are bearish factors for commodity currencies. The Australian dollar, which acts as a liquid proxy for the Chinese currency, slipped in the morning. It continued to decline at the start of the Asian session despite the US dollar's weakness. The Aussie as a commodity currency dipped today because of the falling oil prices. As a result, it was trading mainly in the downward range of 0.6804 and 0.6853, and the Aussie ended the Asian session at 0.6812. The consolidation of the US dollar may put pressure on the Australian dollar ahead of the Fed meeting next week. As for the Reserve Bank of Australia rate decisions, there is still a chance that the Reserve Bank of Australia could raise the interest rate. It helped the pair rebound slightly from its intraday lows. And the New Zealand dollar fell even more sharply after the 5-month high reached last week. Such a drop looks very discouraging, having declined for the second session in a row. The Kiwi dollar pair approached 0.6335. New Zealand's inflation data for the second quarter will be published tomorrow. A decrease in the consumer prices from 6.7% is projected. The Kiwi dollar pair started the new week on a pessimistic note. In Asian trading, it slid into the downward range of 0.6332 and 0.6372. Apart from a New Zealand CPI, the Reserve Bank of Australia meeting minutes and Japan's inflation data are due this week. We advise you to remain cautious when trading Asian assets. That's all for now. Subscribe to our channel and stay up to date with the latest market news. See you soon!